Hello and welcome to another episode of Who Said What. I'm Kashish, filling in for Krishna, and this is a show where I dive into interesting comments from notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. Today, I have three interesting comments for you. First, it's from De Beers CEO on India as its biggest market. Then, it's from Nomura on how India's worst inflation might be behind it. And finally, from CEO of solar industry on the state of the defense in India. So let's start. For decades, diamonds were not just marketed as precious stones, but as a profound symbol of eternity. At the heart of this transformative marketing brilliance was De Beers, a company that single-handedly convinced generations globally that a diamond ring wasn't merely jewelry. It represented love itself, permanence and legacy. However, the dazzling veneer, carefully crafted by De Beers, has faced unparalleled challenges recently, shaking the diamond industry at its very foundation. You might have guessed that I'm talking about lab-grown diamonds or LGDs. Al Cook, the global CEO of De Beers, has positioned India at the forefront of this evolving landscape. In an interaction with the Economic Times, Cook emphasized India's emerging dominance in natural diamonds, stating, "Having toppled China as the world's second biggest market for natural diamonds, India is shining bright for De Beers." He contrasted India's consumer behavior starkly with the growing US inclination towards lab-grown diamonds or LGDs. He further said, "One can buy 20 LGDs for the price of 1 carat of natural diamond. LGD will remain mass-produced, low-cost, pretty, and fun jewelry to wear. Indian consumers are more sophisticated and they like natural things. They believe in the uniqueness of natural diamonds and therefore the demand is growing." Now, India has decisively overtaken China, a market historically prominent in diamond consumption but currently struggling. According to the Gems and Jewelry Trade Association, China's diamond market contracted drastically from 100 billion yuan in 2021 to merely 43 billion yuan by 2024, reflecting a broader economic uncertainty and shifting consumer preferences towards gold, influenced by surging gold prices. Concurrently, the United States, the largest diamond market globally, is significantly shifting toward lab-grown diamonds. These synthetic diamonds mirror their natural counterparts in both physical and chemical properties, but come at a significantly lower costs, coupled with an eco-friendly and conflict-free image heavily marketed toward environmentally conscious and younger demographic. Highlighting this very shift, Cook noted a stark decline in lab-grown diamond prices, stating, "Lab-grown diamond wholesale and retail prices continued to fall throughout 2024, accelerating notably as retailers introduced deep discounts amidst heightened competition. Some US retailers have even started warning consumers explicitly that lab-grown diamonds may lose their resale value significantly." India's largest jewelry retailer, Titan, which is the owner of Tanishq, Carrot Lane, Mia, and Zoya, revealed notable insights in their recent earnings call. Titan is in wait and watch mode, but for now, it's sitting this one out. They're not yet convinced that the economics of lab-grown diamonds has settled down. The price of lab-grown diamonds has been falling steadily as production gets cheaper and cheaper. From around 50 to 60,000 rupees per carat 1 year ago, many players are now selling them at 30,000 rupees per carat. And even at that price, the margins are still very healthy, which means that even more newer players might enter the market. More price cutting is likely. This isn't an environment that rewards a brand like Titan. So far, they don't seem to be missing much. While lab-grown diamonds are rapidly eating into the market for solitaires, it hasn't yet taken over the market for smaller stones. Over 95% of Titan's studded jewelry sales come from small natural stones, not large solitaires. That part of the market has remained resilient. If anything, the company has seen strong growth in buyers for smaller stones. We came across their commentary through the chatter, where we pick the most juiciest and interesting comments from the earnings calls so you don't have to dial in. Now, coming back to industry's shifting sands forced De Beers, historically protective of diamond prices, to undertake an unprecedented move. Significant price cuts of up to 15%. Such a step, described as capitulation by market observers, starkly contrasts the company's previous price stability strategy. Additionally, De Beers has amassed an inventory of rough diamonds valued at approximately $2 billion, reminiscent of challenging times similar to the 2008 financial crisis. Yet, despite these market strains, De Beers remains deeply invested in the Indian narrative. Cook articulated an ambitious growth trajectory, forecasting the international diamond market could double from $10 billion currently to $20 billion by 2030. Cook emphasized this potential strongly, noting India's natural diamond consumption saw a robust 12% year-on-year growth in 2024 alone. However, beneath these affirmations lies an intriguing contradiction. Historically, De Beers leveraged the compelling slogan, "A diamond is forever," embedding a notion of perennial value and rarity in consumer consciousness. Yet, diamonds have returned virtually no investment gains over the past 22 years, undermining De Beers' long-standing market narrative. For the next story, let's talk about inflation. In a world marked by heightened uncertainty and headwinds, low inflation is India's quiet tailwind. This week, while the world obsessed over tariffs, trade tensions, and central bank hand-wringing, one line quietly cut through the noise. It came from Sonal Verma at Nomura, and it captured something most people hadn't noticed yet, but might look back on as the turning point. India, she said, is entering a new phase, a quieter shift with enormous implications. After years of fighting inflation, India may have finally won. To grasp why this is such a big deal, you have to rewind to 2019. Inflation had been a chronic problem for India, sticky, persistent, and unpredictable. The pandemic made it worse. Then came war, supply shocks, and climate swings that sent food prices soaring. For 6 long years, inflation stayed above RBI's 4% target. Policymakers could do little more than react, always one step behind. But April 2025 brought a surprise. Headline CPI inflation fell to 3.2%, the lowest level in almost 6 years. For once, inflation wasn't the problem. It was the opportunity. The shift isn't just 1 month fluke. It's rooted in real, tangible changes across the economy. Food prices are falling fast. Vegetables are down 11%, pulses by 5%, spices by 3%. Rains have been generous, reservoirs are full, and the Rabi harvest looks good. Even the famously volatile food basket is behaving. And then global disinflation is helping. US-China tensions have diverted cheaper Chinese goods to markets like India. Imports from China jumped 26% year on year in March-April, easing input costs. Next, domestic costs are also easing. Fertilizer, diesel, and fodder, which are key inputs in agriculture, are also getting cheaper. Rural wage growth is muted. Industrial and energy costs are also softening. Even urban wage growth, proxied by listed company salary expenses, is slowing down. There's a slack in the system. Credit growth is tapering, private investment remains cautious, and global demand is weak. That keeps a lid on demand-driven inflation. The rupee isn't under a lot of pressure too. A soft US dollar, concerns over US fiscal health, and Northeast Asia trade dynamics are giving the rupee much more breathing space. This isn't just low inflation, it's broad-based, sticky, and cyclical disinflation. As Verma notes, trimmed mean CPI inflation fell below 4% back in January 2024 and was just 3.3% this April. The RBI's core inflation gauge looks elevated only because of gold prices. Exclude those and core inflation is running at 3.5%. Now you may ask why this changes everything. If inflation is finally under control, then the RBI has room to act. And it already has. The central bank cut rates by 50 basis points and adopted an accommodative stance. But Verma is going further. She expects another 100 basis points of cuts, bringing the repo rate to 5%. That would be a full-blown easing cycle, deep, deliberate, and very different from the last 6 years of caution. This also gives India the rare freedom to diverge from the US Fed. While the Fed worries about tariff-induced inflation, India can now actually focus on growth. As Verma puts it, disinflation in India will stand in stark contrast to the tariff-induced inflationary shock expected in the US. Now, what does this mean for everyone? This quiet tailwind has sweeping effects. Households, for one, get a break. Lower EMIs, cheaper credit, and relief at the grocery store. Companies will also see better margins as input costs are falling, while borrowing costs ease. The government gets policy headroom too, less need for fiscal firefighting and more space to consolidate. And finally, investors can see macro stability. low inflation, strong reserves, and steady growth expectation. And in a world where economic surprises tend to be nasty, this is a rare kind of surprise: positive, sustainable, and under the radar. What about the risks? Of course, nothing in economic ever moves in a straight line. She flags key risks: erratic weather, geopolitical shocks, and global financial volatility. If there's a deeper global slowdown, even India's momentum could wobble. But here's her central insight. Unlike before, India now has the room to absorb shocks. Inflation isn't a constraint now, it's the cushion. After years of treating inflation like a chronic illness, India is suddenly in a position of strength, and nobody's really talking about it yet. Verma's phrase, quiet tailwind, is more than a clever turn of a phrase. It captures the real economic inflection point where low inflation, restrained demand, and stable fundamentals converge to give policymakers space. This might be the most underappreciated story in the global economy right now. While the rest of the world scrambles to tame prices, India's challenge is the opposite: how not to waste this disinflation divide. The question isn't whether the RBI can cut rates further, it's whether they can afford not to. And in the final story of the day, we're diving into solar industry's earning call, where CEO Manish made some remarkably candid comments about how global conflicts are driving their defense business to unprecedented heights. Here's what CEO Manish said about the current geopolitical climate.
Look at the current geopolitical situation in media articles. Definitely, government is trying to buy many items on emergency procurement route.
But it was his next comment that really raised eyebrows.
Things to happen. If you look at after World War II, there was no big event happen. So sometimes these things can convert and conflicts can convert into the bigger things or bigger wars. So nobody wants them. But to secure ourselves, we as a country or all the nations would like to invest in this sector.
So what's really going on here? You see, Solar Industries isn't just any company. They're India's largest private explosive manufacturer, and they've been quietly building a defense empire. And the numbers back up CEO Manish's view on where the world is heading. Just last month, the Stockholm International Peace Research Institute, or SIPRI, released some staggering data. Global military spending hit $2.7 trillion in 2024. That's a 9.4% jump and the steepest rise since Cold War ended. Over 100 countries increased their defense budgets. Here's the context that makes comments so much more significant. The numbers tell the story. Their defense revenue exploded 162% this year.
The defense sector revenue has increased, showing a growth of 162%.
They're sitting on a massive order book worth billions.
So as we receive orders, we will definitely share. But as of now, the total order book from defense is around 15,000 crores and around 2,000 from non-defense.
Next year, they're targeting 30% of their total revenue from defense alone.
In FY26, with this, defense contribution in total revenue will be crossing 30%.
And what about the global context? CEO Manish talks about conflicts converting into bigger wars. He's not being an alarmist. He's reading the room. The SIPRI data shows European military spending surged 17% in 2024, while Middle Eastern spending jumped 15%. Russia doubled its defense budget since 2015, and even Germany, traditionally cautious of military spending, increased its budget by 28% to become Europe's biggest defense spender. Now, with ongoing tensions in Ukraine, the Middle East, and rising defense budgets globally, solar industry has positioned itself perfectly for what they clearly see as a defense spending supercycle. Here's what makes this particularly interesting. While most companies stumbled into defense opportunities, solar industries has been playing the long game.
Very few companies in this market has really spend on building capacities for defense products. And solar is one exception which has kept investing in developing the products, developing the facilities.
They've spent years qualifying their products with international customers, building state of the art facilities, and developing everything from rockets to advanced munitions. When geopolitical tensions started rising, they were ready. Global instability is great for business. Solar Industries has become a direct beneficiary of what they see as an inevitable increase in military spending worldwide. Their products were reportedly used in recent military operations, and they're expecting more emergency procurement orders as governments rush to beef up their arsenals. The bottom line here is Solar Industries had turned a geopolitical uncertainty into 15,000 crore opportunity. Whether you find that pragmatic or unsettling probably depends on your perspective. But one thing is clear. In a world that feels incredibly unstable, companies like Solar Industries are positioning themselves not just to survive, but to thrive. That's this week's of Who Said What, where sometimes the most revealing thing isn't what the CEOs say, but how comfortable they are saying it. What do you think? Is solar industry being smart or opportunist? Let me know in the comments. And that's it for today. I'll see you in the next one. Shifting stands force. नहीं, क्या लिखा है?
बे जल्दी बोल, कल सुबह पनवेल निकलना है।
Nice.